Hi, and good afternoon. My name is Larry White. I'm a former president and board member of FIASI and have been involved in FIASI's ESG events, working alongside Henry Schilling, who leads our ESG efforts, Laura Nauser, and others, including our friends at Fordham University. We're here today to celebrate and focus on the second annual FIASI Gabelli School Student Research Competition on ESG, focused on investments and innovations in the market. And I want to welcome you to this event in which we're going to highlight our recent competition. And we're very excited that we have our two primary winners of the recent competition who are going to share in their research, or going to share their research. Before we get to the main event, however, I want to share a few remarks. This is our second annual research competition on ESG, as I mentioned, and last year we focused our efforts on a few universities in New York City, while this year we have expanded our scope to include about 40 universities and colleges in the tri-state area. We had this year 14 research submissions compared to 6 last year, and the research was judged by a panel of seven professional researchers, including 4 individuals associated with FIASI and 3 professors from Fordham University's Gabelli School of Business, who's FIASI's partner in this competition. The research was judged using 4 different metrics: its contribution to the industry, the communication around its discussion of the topic, its theoretical or conceptual soundness, and the soundness of its methodology. And after reviewing the research papers, 5 winners were selected, including first prize winner, which was a research piece entitled Fresh Start or Fresh Water, the Impact of Environmental Lender Liability, which was submitted by Aymeric Bellon. And Aymeric won $5,000, was awarded $5,000 for that first prize. The runner-up winner with a paper entitled Climate Change and the Partisan Divide and Exposure to Climate Risk was submitted by Song Zhang, and Song won $3,000. And we had honorable mentions. We had 3 separate papers that won honorable mention, and they each won $500. The first 2 were Jitendra Aswani and Ayan Panjwani. Those were the 2 first papers. And the third, all equally, honorable mention, but the third was submitted by 3 individuals: Alona Beloka, Mingyang Chang, and Mingchuan Fu. So congratulations to all the winners, and thanks to all who submitted papers this year. And I also want to thank those that reviewed the papers. Before moving on, I want to share some comments about how you might participate in today's discussion. To submit questions, we ask that you use the Q&A button on the lower part of your Zoom screen. The moderators will either read the questions and have them answered, or someone will respond by typing the answer. We are recording the conference, which will be posted on our website afterwards for all to watch again or to share with others. I now want to turn our discussion over to Dr. Donna Rapaccioli, who is the Dean of the Gabelli School of Business at Fordham University. Donna, over to you.
Thanks so much, Larry. I'm delighted to add a brief welcome on behalf of the Gabelli School. First, I want to express my gratitude and pride in our longstanding partnership with FIASI. From my perspective, together, we're raising awareness of the role that fixed income can play in advancing society and advancing environmental, social, and governance topics. Together, as you'll see today, we are inspiring the next generation of scholars to be active in the ESG credit space. I'm particularly proud of all the students who submitted papers. As Larry mentioned, there were 14 papers submitted, and I want to congratulate everyone, including our honorable mention papers, a runner-up, and the first prize winner. Congratulations to everyone. Really, really well done. Their work reinforces for me what an exciting time it is for credit and fixed income analysis. An exciting time for FIASI and the Gabelli School to continue and grow our partnership and collaborate even further. I also want to mention that the Gabelli School earlier this year in March launched the O'Shea Center for Credit Analysis and Investment. So please look for other events surrounding the credit area that you can attend and participate in. In closing, I want to thank in a very special way Henry Schilling of FIASI and Professor Anyan and Professor Shrish Chatterjee for their vision and their hard work in bringing this scholarship competition to reality and to having such a great growth in just 1 year. So thank you all and everyone behind the scenes, including Linda. So now it truly is my pleasure to hand the podium over to Professor Shrish Chatterjee, who is the Gabelli Chair in Global Security Analysis, and he will lead us in our first paper discussion.
Thank you, Donna. Thank you, Larry. I will not take up too much of our time here because we have a tight time schedule. So the first paper is going to be presented by Aymeric Bellon. Aymeric, are you able to share your screen and present the paper? Let me just quickly say that you have 20 minutes for presentation. I will send you a little note at the end of 15 minutes. And then after your presentation, we'll have 5 minutes of Q&A. So with that very brief introduction, please take us through your research.
Thank you very much. I would like first to thank the organizers for organizing this event. I think you are really helping the field of ESG finance. And I think as I'm working in this field, I'm very grateful for that. So today I'm going to present the following paper, Fresh Start to Fresh Water, the impact of environmental lender liability. So the disclaimer, the usual disclaimer applies, like any view expressed are mine and not the one of the US Census Bureau. So the research question I'm asking in my paper is the following. Can environmentally responsible lenders reduce debtors' pollution? So in this question, you have this idea that whether a lender can have an impact on firms' environmental responsibility. This is not totally clear, you know, like an equity holder have some control rights and basically decide what type of actions a firm can do. A lender does not have like some direct control rights. So it's pretty unclear whether a lender can have an impact on firms' environmental practices. And today I'm going to take a very legal definition of environmentally responsible lenders. What I'm going to do in this paper, I'm going to define a lender that is responsible if the lender is exposed from a legal point of view to the environmental cleanup cost attached to the collateral of its debtor. So to take an example, like you have a plant that is incurring an environmental contamination. Then there is the EPA that is cleaning up the site. What happened next is that basically an environmental claim is issued, and then you have the question, who should pay for this environmental claim? And maybe lenders should be the one that also pay for this claim because they have some part of ownership in this asset. And then in the second part of the paper, what I do is I try to understand whether this compliance that is induced by lenders distort real outcomes. So you could think of this second part of this paper as trying to understand a bit more whether lenders' monitoring is efficient or not. You know, maybe lenders are able to reduce debtor pollution, but at the same time, they completely distort firms' production decisions. You know, like if tomorrow lenders they stop lending to all firms that pollute, for sure you will observe a reduction in pollution, but the social cost will be so high that it might not be very optimal. So you could think of the second part as trying to understand the optimality of this monitoring by lenders. So my paper, the result of my paper in a nutshell are the following. I use a novel quasi-experimental research design and a novel linkage of administrative data sets to answer this question. My first result is that when lenders are less responsible for the environmental liability attached to their collateral, pollution increases, and it increases in a very significant manner. Then I try to understand a bit more what are the distortions that this monitoring creates on firms' employment and real outcomes. Actually, I don't find any distortion on production and wages. I do observe a small increase in employment by 2%. Then when you benchmark these results with what people have found using other type of policies, actually you could think that lenders are able to induce data to reduce pollution in a way that is efficient if you take as a measure of efficiency the real distortions on firms' production, employment, and wages that an increase in environmental compliance creates. And this makes sense, right? Because lenders, contrary to an API attorney, care whether the facility will file for bankruptcy. You know, like a lender will never ask a debtor to reduce pollution if the day after this debtor will be filing for bankruptcy. You know, like the lender internalize because of the debt structure because of a debt contract. The lender will internalize any distortion of environmental compliance on production that will affect the bankruptcy rate. And that's basically the paper. So what I do like to identify, so the ideal experiment will be to randomize environmental lender liability and then, you know, observe pollution and employment outcomes. So to come closer to this ideal experiment, what I do in the paper is that I exploit one of the most important milestones in US environmental law, which is the Lender Liability Act of 1996. And what this act did, it basically significantly increases the protection given to lenders regarding the environmental liability attached to their collateral in 1996. What is interesting for us, for financial economists, is that before 1996, because of different circuit courts decisions, different places were subject to different lender liability standards. So for instance, if you are a lender with a collateral located in the 11th circuit, you are much more exposed to the liability attached to the firm collateral. You are much more likely to have to pay for this cleanup cost. Whereas if you were not in the 11th circuit, you are a bit more protected because of different court decisions. So you know where I'm going here. You have different places with different lender liability rule. I'm going to do a difference in different specification. I'm going to basically compare my outcomes between the group you see in gray and the one in blue, both before 1986 and after 1986 in a standard difference in different specification. And I estimate this empirical design using a novel matching of administrative data sets. So I am one of the first to match the EPA data to US Census Bureau data. And this allows me to observe a rich set of firms' outcome. I can observe pollution coming directly from the EPA. And I also observe employment coming from the IRS and payroll and production coming that are kind of reliable coming from monetary US federal survey. So then the second advantage of having this data set is that it basically allows me to improve the identification strategy by basically now I'm able to include like different industrial time trend, chemical time trend, or also control for different legal status, which also like help me to improve the identification strategy by making sure that the type of plans we're comparing between the two groups are comparable. So my first dependent variable is on-site circular releases. And this variable is basically highly correlated with the risk of a toxic releases by a plant. According to EPA, you like releasing your toxic components using on-site is the least preferred approach to handle toxic waste because you are much more likely, and people have shown it empirically, to incur a subsequent contamination when you have more pollution on-site. So what I do first is I basically simply plot the raw average of my dependent variable on-site circular releases for both my treated group that you see in red and my control group that you see in black for each year and normalize in 1994. And just by plotting the raw averages, what you can see is that we don't have any pre-trend before 1986. We do observe an increase in pollution when the law is discussed and passed, and then you see this increase is constant. Then what I do here instead is I basically take the difference between the red point and the black point, and I'm going to control for all the variables that could affect, that could create a wedge between the 2 points. I'm basically doing a dynamic difference in different specification, where I put like all the controls you can think of. This the same conclusion appear. Like you don't have any impact of, you don't have any pre-trend before 1985. You see an increase in pollution when the law is passed. And this increase in pollution is economically meaningful. We are talking about a 14% increase in on-site circular releases. Then I just replicate the same specification, instead that now I use as my dependent variable whether the facility is incurring some environmental violations. And you can see that the number of environmental violations increase when lenders are less responsible for the environmental liability attached to their collateral. So then in the paper, I try to understand why do we observe such an effect. And the first effect I have in mind is, maybe this is driven by a change in production. And I can think of 2 different micro foundations for such an effect. The first one is now lenders are more liable, so they stop lending. It's not worth for them to lend, because if they lend, they know that they have a small probability of having this huge cleanup cost. So basically, you have you can think of a participation constraint that is no longer satisfied, and now lenders, they just exit the lending market. But one consequence of that is that now firms are more financially constrained, and we know from Finance 101, when a firm is more financially constrained, production and investment drops. So now, one interpretation is, now lenders are more protected, they are able to lend more. So then we observe a mechanical increase in production, and as production and pollution are related, this creates like an increase in pollution. And the second macro foundation you could think of is basically that firms reallocate production in less regulated areas. So we know that firms are very rational animals, right? If there is one region that is more regulated, they have a strong incentive to put all their assets in the least regulated part of the country. So what happened is basically after 1986, you could think of it as a deregulation. So basically now firms are basically putting back all their production to the places that were highly regulated before, because now these places are no longer regulated. And then this could create an artificial increase in production. And as production and pollution are mechanically related, this also creates an increase in pollution. So I ran many tests, and none of them really support this channel. So the first test is I basically look at the impact of the change of the treatment on production, sorry. And I observe a precise 0 effect on production. So production do not really change after 1986 for my treated group. So you might think, maybe we have like a small change, and maybe this change is not statistically significant, but we have like production is highly convex in pollution. So basically, even a small change in production could generate like large change in pollution. So what I do is I simply replicate my baseline estimations, instead that now I control directly for production. And you could think that production is measured with noise. So I include like different proxies, where I include like input measures and output and cost measures. The point estimate does not change when I control for production. So something that is nice with my empirical setting is that the type of pollution I'm looking at, namely circular pollution, is not all the type of pollution that firms make. Like some firms, they can pollute, and this pollution will not be exposed by circular liabilities. So what I'm doing is I run a test where I observe an effect in this type of pollution that are not affected by the change in the law. And if the effect is driven by a change in production, you might expect that all type of pollution will increase mechanically. And what I show in the paper is that I observe a precise 0 effect on non-regulated pollution by the shock. Whereas one of the most, I think, convincing tests I do in the, I think, to show that the effect is not driven by a change in production is to look directly at investment that aim specifically at reducing pollution. And I observed that basically after the treatment, firms take less effort to reduce pollution, as I observe a 15% drop in investment in pollution reduction projects. So here I basically replicate the exercise I did before. So here it is like the number of, and it is where the propensity of investment in pollution reduction projects for my treated group. Here it is for my control group. You can see that just after the treatment, firms exert less effort in reducing pollution. So then a second test, last test I do is maybe the effect is driven by lenders' influence. You know, lenders have a rich set of contractual tools to influence debtor practices. They could do like discriminatory pricing. You're polluting, so now you become risky if you have more lender liability. As a result, now you become riskier. So now basically I'm going to ask you to pay a risk premium. But firms, they want to avoid paying this risk premium. They want to reduce cost, right? So if by becoming cleaner, you can reduce your borrowing cost, then this creates a huge incentive for firms to become cleaner. Then the second test I do, and then like one possible channel you can think of is maybe the effect is driven by a contractual channel, you know. Maybe firms write covenants and, thank you. Maybe firms write covenants that specifically ask firms to adopt good environmental practices, like taking some remedial actions, some disclosure, and so on. So I don't have like data on loan contracts because I'm looking at firms in the 90s and don't have like good database for debt contract in the US. What I do instead is I run some cross-sectional tests that are consistent with the idea that the monitoring is made by lenders. So the first test I do is that I show that the effect is significantly stronger for firms that are closer to file for bankruptcy. And this makes sense, right? Because if you're a lender, you want to monitor firms that cause the highest risk for you for your balance sheet. And CERCLA is a type of liability that arises only for bankrupt entities. If you're not bankrupt and you have a contamination, you are regulated by RCRA, which is another statute. Therefore, we should observe more monitoring by lenders for firms that are close to filing for bankruptcy, which is exactly what I found in the paper. So then, theoretically, lenders will be much more likely to monitor debtor practices if they have high bargaining power. So one proxy I use for bargaining power is the firm initial leverage. And I show that basically we observe stronger effects for firms that have high initial leverage, consistent with the idea that they don't have enough bargaining power and that they are more likely to be subject to the influence of the lenders, you know. And it makes sense, right? If you don't use debt to begin with, you will simply don't really listen to what lenders are saying, right? You will not, if your lenders are asking you to become cleaner and you don't use debt or you use like a small fraction of it, you will simply ignore it if reducing pollution is costly for you. Then I show that the effects are significantly stronger for chemicals that are more toxic, and which is consistent with the idea that basically lenders focus their monitoring effort on cases that are more likely to create like higher liabilities. So one important thing is that lenders will observe some signal about the type of the facility, whether it's a facility that is much more likely to incur future contamination or not. And so this is a theoretical model. You know, when you increase lender liability, lenders will use like some signal to monitor whether to basically monitor more strongly firms that are more likely to create some environmental contamination. And consistent with this channel, I found that the effects are significantly stronger for firms that have high ongoing environmental liability. Finally, so I read like many environmental reports written by banks and lenders, and the number one factor that I read in this report that lenders use to monitor, that lenders use as a proxy for environmental liability is the age of the facility. And this makes sense, right? If you have a facility that is older, then this facility is much more likely to be subject to a contamination, because in this facility, This facility might have been built at a time of lower environmental standard. This facility might have some old pipe that will break and create a contamination. So you should observe more scrutiny by lenders for this type of older facility, which is exactly what I found in the paper. The effects are significantly stronger for firms that are older. But then in the paper, I try to understand, what are the distortions that this increase in pollution alleviates. And actually, so I do observe an increase in employment by 10 employees, but I don't observe any impact on wages and production. And the main conclusion of this paper is that lender induced compliance with limited distortions on real outcomes when you compare it to other type of policy. So actually, it was kind of a good policy that was, but if you take as a measure of efficiency, the real distortion on firms' production. And this makes sense, right? Because lenders internalize the effects of cleaner practices on default rate. They will, like an EPA attorney is paid according to firms' environmental production. If a firm is polluting, an EPA attorney will ask the firm to reduce pollution if he has to do so. And basically, there is no consideration of whether reducing pollution will create more distortions on firms' firms' employment and production. Whereas lender, they care also about default. So they always, trade off environmental compliance when they are more liable with the production-related distortions. And you might think also that lenders have more information on the cost to reduce pollution than an EPA attorney, because they already collect a lot of information on the collateral value when they have a secured loan contract. Then in the paper, I run many robustness tests. I don't have time to go over them. So to conclude, this is the first empirical paper to test theories of vicarious lender liability. But I think one important conclusion of this paper is that it basically helps me to rewrite the narrative that led to the Lender Liability Act. Congressmen in the 90s, they thought that by increasing lenders' protection, you will basically observe an increase in loan supply, because now lending will become less risky. So firm will benefit from a higher supply of lending. And as a result, they will be more likely to, this will reduce the equilibrium cost of capital. Firms that have a lower cost of capital are more likely to invest in production and to make investment, among which investment that aims specifically at reducing pollution. So basically, this act was thought as a pro-environmental act, as a pro-employment act. And what my paper shows is that actually it is not really what happened, at least within the context of my nature experiment. Basically, it also distorted the incentive of lenders to influence debtor environmental practices. So this question, of whether we should make lenders more liable has come back to the debate on ESG and investment. So you have a white paper written by PRI and other institutions, a legal framework for impact, and they basically say that if we want to increase and incentivize lenders' engagement, we should maybe rewrite our environmental liability rules. Thank you very much for your attention, and I look forward to your questions.
Thank you, Aymeric. I know this was a pretty short time to summarize a very detailed paper. Certainly, you chose a very interesting experimental setting. We do have a few questions. I don't know if we'll have time to get to all of them, but let me start with one, which is it possible that banks facing environmental lender liabilities choose to lend less in firms with high environment risk? And similarly, when the environment lender liabilities reduce, banks choose to lend more to firms with high environmental. Do you see this kind of pattern in the data that kind of very intuitively tries to relate the,
No, definitely, that's a great point. That's a great point. You might think that lenders will adjust the supply of capital according now to the environmental profile of their company. And one way to create impact is to basically ask firms to reduce pollution, is to basically ask firms to pay more if they pollute. So in the paper, I lack detailed and comprehensive data on loan contracts. So I cannot directly test it. What I could say is that basically, at the end of the day, production does not change. So if they were making discriminatory pricing, it was working kind of well, because I don't observe any response in production. So basically, they were really if the effect is driven by this channel, basically they were doing it in a very efficient way because it did not create any distortion on production.
Let me see if I can connect something you said in your slides with another question which we have, particularly on the interest rate setting and what role that plays. So in one of your slides, you mentioned that the banks reduce the amount of loan or credit, if I remember the word correctly that you had on the slide. And it's not clear whether there's some kind of capital rationing or leading to the question, which is, do banks price the high environmental risk, the magnitude of environmental lender liabilities, and their expected degree of monitoring in interest rates? Do you see any change in the loan rate from old loans to new loans just around 1996?
No, that's a great point. That's a great point. That could be one way to create impact, is to basically, change the interest rate and ask, like, if you're polluting, I'm going to ask you to create a, right? So I see your point. There is two questions. Like, the first one is basically interest rate change because now lenders are monitoring. So they want to incentivize firms. So basically they have some discriminatory pricing. And the second one is basically, even if they do some contractual monitoring, like I'm going to write more environmental covenants, then as a result, they should basically price this cost on the interest rate. What I can say is that if there is a change in interest rate, this change in interest rate is not big enough to create any distortion on production because production remained the same. So of course, all this is private, right? Like private, I have private firm, and so I don't observe like detailed and comprehensive data on the interest rate that firm face. However, what I can say is that if there is a change in interest rate, this change of interest rate is not big enough to create some distortion on production.
Thank you very much. I think we are probably coming to our time limit. So let me stop here. Thank you once again. Thank you once again. And let me request all the other attendees to please write to the author. In this case, please feel free to write to Aymeric if you have any other questions. With that, let me hand it over now to our next presenter, which is Song Zhang. Lauren. Okay, I'm going to switch off from my side.
You're muted.
Can you hear me? I'm not muted, it looks like.
No, you're okay now. Go ahead.
So our runner-up is Song Zhang, Boston College. His talk titled Climate Change, the Partisan Divide and Exposure to Climate Risk. Song, the floor is yours.
Thank you. Thank you for the introduction. I'm really grateful for FIASI and Fordham University for hosting this event. So I'm going to talk about my job market paper. It's about how different views about climate change at a financial institutional level affect their investment exposure to climate risk. As you can see, I have changed my affiliation from Boston College to University of Delaware. I'm going to do a assistant professor there. I hope you like this paper, and I'm looking forward to your questions and comments. Let me start off by providing an estimation given by Swiss Re. Swiss Re is the world's largest reinsurance company with more than $200 billion in total assets. And they estimate that by the middle of the century, because of climate change, the global GDP could go down by almost 18%. Okay, so people might have different views about this 18% as a number, right? Some people think it's too high, some people think it's too low. Intrinsically, people have different views about climate change and its potential impact on the economy. The question here is, does different views about climate change will lead to different investment exposure to climate risk? People might holding different amount of climate exposed assets because of their views about climate change, right? So what do we know so far in the literature? Yes, in the household side and the real estate market, this is considered it has been documented. So people have shown that in democratically leaning areas, the real estate market price in the climate risk, while Republican leaning areas, the real estate market do not. And also people have shown that Republican leaning households are more likely to purchase coastal properties that are exposed to sea level rising risk than democratically leaning households. So what I'm going to do in this paper is I'm going to extend the literature from the individual side to the institutional investor level side. So why do we care about financial institutions? Why is this an interesting question? Because this is given these fundamental rules of financial institutions in our financial system, right? If financial institutions' view about climate change affect their investment exposure to climate risk, we can see different institutions in holding different amounts of climate risk, right? So this brings the question of whether we should consider potential financial crisis driven by climate change, whether we should hedging these positions of different financial institutions regarding to climate risk. And moreover, if you think about the areas that are exposed to climate change, does this affect the local population's access to banking services, etc., right? So this could have profound implications for policy-wise. So formally, this paper studies, do the views about climate change affect institutional investors' exposure to climate risk? And naturally, there are several challenges here. First, how to measure institutional investors' exposure to climate risk. And second, the view about climate change from these financial institutions, by definition, are very hard to measure, right? And then also we have identification challenges here. So the second I'm going to propose here is mortgage lending market, and I'm going to use wildfires as the representation of climate risk. Specifically, I'm going to combine the physical location of mortgage applications in combination with the wildfire risk measurement at the county level to measure the mortgage applications' exposure to fire risks. And then I'm going to capture the lenders' climate change views using their political preference variable, captured using the fraction of corporate political donations to Republican politicians. I'm going to justify why I'm going to use this measurement later. And then I'm going to use a high-dimensional fixed effect, including county by year and bank by county fixed effect to address potential variety of confounding factors you might have in mind. So what do I find in this paper? At the mortgage application level, I find that Republican-leaning lenders have a much more optimistic mortgage approval rate than Democratic-leaning lenders in the same areas. I do not find this effect in non-fire-prone counties. Okay, and then at the firm level, I show that the Republican-leaning lenders hold more mortgage loans that are exposed to fire risks. And then naturally, you would expect to see that as fire risk grown locally in a region, the local market shares of Republican-leaning lenders increases correspondingly. Okay, this means that when you have fires, risk increases over time, then this Democratic-leaning lenders might retreat from these areas, while Republican-leaning lenders increase in the market shares. And quite interestingly, this effect only exists among non-conforming loans, which means second lien or jumbo loans. This is interesting because it tells you how this securitization process affects mortgage lenders' risk-taking incentive with regard to climate risk. And the mechanism I have in mind here is a belief disagreement about climate risk. I'm going to rule out a number of alternative explanations, and also provide a series of supporting evidence here. For the sake of time, I'm going to skip the literature and the data. Just a sample, for the sample-wise, the sample period is from 2012 to 2019. It covers over 80 mortgage lenders, including more than 1/3 of all the mortgage applications during the sample period nationwide. So it's by no means a small sample. I'm going to explain two key variables I have constructed in this paper. First one is fire risks. Why I use fire risks as my main measurement of climate risk? I think this is because fire risk has increased substantially over time. But in the finance literature, we haven't thoroughly studied this kind of risks. This is the first paper to propose this measurement here. So just give you some numbers here. The number of acres burned by wildfires in the United States have increased from 2 million acres to 10 million acres in just 40 years. 10 million acres is actually twice the land area of Massachusetts. So it's not small at all. And according to CoreLogic, over 600 billion real estate properties are at risk of fire risks. Okay, so it's also a large properties being exposed to the fire risk. What makes it really worse is that there's a lacking of this wildfire insurance policies. And like flooding insurances, you also have the government back it up. Wildfire risks mostly are covered by commercial insurance companies. And due to this increasing nature of wildfire risk, insurance companies often withdraw their insurance policies in these fire-prone counties. And in this paper, I'm going to measure the fire risk using the fraction of land in the high or very high, in a county that are classified as high or very high risk, according to this map, which is a wildfire hazard potential map obtained from USDA. Okay, so the next key variable here I'm going to use here is partisan views about climate change. So the way I measure institution-wise the view about climate change is their political preference at a firm level, using the fraction of lenders' corporate PAC contributions to Republican politicians. Why I use this one? Because it is following the long literature and survey evidences on how the partisan divide about climate change. People, if you look at the survey evidence here, these bottom two figures show that this gap between Republicans and Democrats about climate change have increasing over time, right? So, but although this is at an individual level, I can assume that this probably also exists at the firm level. And I'm provided the validation evidence using the firm level climate change measurement provided by Saunter et al. And this paper I think is forthcoming in the GF. So what I show in this test, although it's not listed here, is that during conference calls, Republican-leaning lenders are less likely to mention climate change. And when they do mention climate change, they have more positive sentiment in general. So I think this measurement at least partially capture this climate views of the financial institutions. And what about my empirical strategies? There are several issues you have to consider here. Of course, the first one is Republican-leaning people and Democrat-leaning people, or Republican-leaning institutions, Democrat-leaning institutions have so many different ways, differ in so many different ways, right? They could be more conservative, more risk-taking. They might have different economic outlook depending on who is in office, right? And then locally, you have these local business economic cycles, such as local GDP, mortgage demand, real estate price, and also you have this macroeconomic environment, right? Like interest rates change over time. And then you also have the time environment characteristics of lender branches. For example, some of the loan officers in one branch might be more leniency than another branches, right? And that also have non-random matching of borrowers to lenders. To address these issues, I use this following model. The coefficient we're interested in here is beta 2. It basically tells you how Republican lenders behave differently from Democrat-leaning lenders in high-risk areas. So it's captured this effect. And I'm going to control the county by year fixed effect. So this one will address the potential issues associated with local economic cycles and a microeconomic environment. And I'm also going to control for the county by lender fixed effect to control for this time environment characteristic of lender branches, right? As I'm double clustering by the lender and the state of mortgage applications to address for standard errors biases. What are the main results here? So I'm showing that for the first lien, for second lien mortgage applications, which are non-conforming loans, right? The Republican-leaning lenders are more likely to approve these applications. So the dependent variable is a dummy variable at the mortgage application level, whether this loan is approved or not. What I show here in the first column is that when you regress this dummy variable on my measurement of the climate risks, it doesn't have a significant coefficient at all. Or in the second one, when you interact with high risk, with climate risk, it shows a much positive coefficient. What it tells you is that in the high risk counties, Republican-leaning lenders are more likely or implement a more optimistic mortgage policies than Democratic-leaning lenders. And in these non-fire prone counties, which is Republican-leaning donation itself, this is 0. It's statistically indifferent from 0. So if you're thinking about this general difference between Republican-leaning banks and Democratic-leaning banks, you might be observing a significant difference here. but in fact, it doesn't really capture that part. So all this coefficient is significant on the interaction term, suggesting that this is more concerning about climate risk, right? And for conforming loans, this is what I mentioned earlier. This is more interesting because even with a much larger sample size, almost twice the sample size here, this coefficient is become much weaker. Why this is the case? Because of conforming loans, the banks played a role of intermediary between the GACs and the consumers, right? So what they will do is they will issue the conforming loans to the borrowers, and then they will sell these conforming loans to the government, Freddie Mac and Freddie Mac, right? So in this case, these loans do not stay in the portfolio, so they are not really bearing any kind of risk associated with these loans. In this case, I think they have little incentive to price in this risk. So that's why you see an almost insignificant coefficient in this test. And then I can rule out several alternative stories. The preferred story here is belief disagreement about climate change. I'm going to only mention a couple of them. The first one is wildfires most happen in the Western states, which are democratically leaning. So you might be thinking about is perhaps due to the local population difference with the banks, right? So what I did here is I split the sample into red and blue counties based on their voting in the presidential elections. And I find that there's an effect in both samples. And second, there is a recent GF paper showing that lenders might have partisan views depending on who is in office. So I'm a Democratic leaning people, I'm a Republican leaning people, and if I have a Republican leaning president in office, I have a better economic views in the future, right? So what I additionally do here is additionally control for the political alignment with the president in office, and I do not find any effect there here. And third potential story is about the general risk preference of the lenders. You might be thinking about maybe Republican-leaning lenders are generally more risk-seeking than Democratic-leaning lenders. So they are willing to take more risk regardless of what kind of risk it is. So in this point, I tested whether the Republican-leaning lenders are more likely to approve mortgage applications with higher loan amount to income ratio. I find not. So this suggests that they are not really more risk-seeking in general. There are many other kind of stories kind of rule out in the paper. For the sake of time, we'll skip now. I have provided several supporting evidences about this mechanism. The first one is coming from denied mortgage applications. If a bank is really concerned about climate change, they're mostly concerned about the value associated with collateral, right? Will the wildfire in the future destroy the collateral value of the underlying mortgages? So in this sample, I'm looking at all the denied mortgage applications and looking at the reason why the bank denied mortgage applications. I code it as a 1 if this banks deny mortgage applications because of collateral-related reason and 0 otherwise. And the finding here is that in the fire-prone counties, Republican-leaning lenders are less likely to deny mortgage applications for collateral-related reasons than Democratic-leaning banks, suggesting they are less worried about the collaterals in fire-prone counties than Democratic-leaning banks, right? And moreover, I show that for the approved mortgage loans, these are the loans that have been approved, right? I show that these Republican banks actually holding these loans for longer period of time than Democratic-leaning banks. So they seems less concerned about this risk in their portfolio in general. And then for the interest rate, this is much weaker evidence because it only covers like the half of a sample. This is due to some specific details about home data. So what I show here, Republican-leaning lenders seem to charge a lower interest rate than Democratic-leaning lenders, but it's much weaker evidence, only exists in jumbo loans, not in second lien anymore. After that, I'm looking at, hopefully I have rigorously prove that this channel is correct. And then I'm looking at how did it affect their holdings in terms of climate risk. So this sample, I collapse the mortgage applications to the bank branch level, right? So I calculate how many loans this bank issue in each county each year. This is at the bank county year level. What I show here is that at this level, you can see that Republican banks actually holding more amount of loans of non-conforming loans, meaning second lien and jumbo. And this magnitude is not small at all. So just give you an idea of the magnitude. If you think about the average size bank in the sample, which is a size like Capital One or KeyCorp, you increase the standard deviation of the Republican banks by one standard deviation, it actually increases their holding of fire risks by $5 billion, which is not small at all. And then one last figure I want to show here is that I'm looking into this, how this impacts on the local mortgage lending market. What I show here is that if you have, there's a positive correlation between changes in wildfire risks in the local areas to this Republican lending banks market share. As the fire risk increase over time, actually Republican lending banks occupy more market share in these regions. This is the last figure I'm going to show here. Just to conclude, I asked a question about whether different views about climate change affect financial institutions' investment decision to climate risks. Right? I use the setting of mortgage lending market and their political preferences as a measurement. And the key takeaway here is that this does affect their exposure to climate loans, and they have potential implications for policy-wise discussions. Thank you. I hope, did I go over time? Sorry about that.
So you're 3 minutes under, so that's great. Thank you very much for your presentation. How values, those related to climate change in particular, influence firm decision making? Important, exciting, timely questions. So very interesting. Thank you.
Thank you.
We have some questions for you. One, you attribute your findings to different expectations about climate risk between Republicans and Democrats. So Republicans underweight climate risk compared to Democrats. This perspective basically says that their different values shape their risk-return models of the world. And it looks like there might be some alternative explanations. You went through several alternative explanations, but there might still be a little more. So one is that Democrats may make more discretionary choices, like PERC, as in classic principal agent models. So although both Republicans and Democrats might evaluate climate change related property risks similarly. And the other explanation is that Democrats may be more worried about getting bad press for being associated with climate change related properties than Republicans. So again, despite similar property risk evaluations. So would you speak on these alternative explanations?
Sure. So I think there's a couple of supporting evidence probably really taken the point, right? Because one of them is saying that Republican lending banks are less likely to deny mortgage allocations for collateral issues, suggesting they are less worried about the collateral safety, right? This could potentially, of course, it's done fully rule out that this kind of mechanism you have in mind. But I think this is potentially really kind of supporting this interpretation of their risk channel. But for the other ones, I probably need to think more. Thank you.
Another question we have here, your paper focused on mortgage approval versus non-approval, but approval on what terms is also a critical question in mortgage applications. So would you talk about that a little bit?
Can you rephrase the last question? Like a bit
so
more.
Approval on what terms, like interest rates? For example, there are some puzzling results. So table 11 in the paper shows that Democrat lenders, although they should charge higher if they think wildfire risk is greater, they charge a similar interest rate.
So the paper, what you have seen in the paper, table 11, is basically the older results. I use this. That one was based on the all conforming loans. That one was from totally different data set from Freddie Mac and Freddie Mae, because the HOMDA data has one limitation. The mortgage interest rate is only populated after 2018. So what I have shown here in this slide is including only the late half of the HOMDA data. So it's two different samples between the slides and what you see in table 11 in the paper. Basically, in this slide, I show that the Republican lender actually charge lower interest rate. Although it's weaker evidence, but I think it's more likely due to the smaller sample bias, smaller sample. I think half a sample. But in general, it's consistent with what we have in mind. Republican lenders charge favorable terms compared with Democrat lenders in general.
So the next question we have, how do non-donors behave? Non-donors may behave without political bias and therefore could serve as a comparison group. So would you speak on that a little?
Yeah, I didn't include these lenders, non-contributing lenders in this sample because I think this is why if you included all the banks who contributing in the federal donations, that are most precise samples you can have because you have all of them in contributing. I haven't really included all the lenders that do not contribute because I don't know how do you really classify them to be Republican or Democrat. But I think I certainly tried that measurement as well.
The next question, does home insurance play any role in your result?
Yeah,
should mortgage lenders be indifferent with insurance on wildfire?
That's a great question because one of the major reason why I use wildfires as opposite to sea level rising or flooding risk is because of insurance. If you think about sea level rising, it probably will happens in 50 years, right? Mortgage loans mostly have 30 years duration. So sea level rising seems to be a distant threat from now. Flooding is different because flooding insurance is backed by the government. You have a FEMA flooding insurance program. So if you want to participate in, you can always participate. Fires is totally different because it's mostly commercial insurance markets. Every year in California, Oregon, Western states, you will see households being dropped out by insurance companies because of the increasing risk in these areas. And very often this insurance company charge high premiums, so the household cannot really afford it. So the mortgage lenders, even if you have the insurance now, doesn't mean that in the future, you will have insurance being covered by the lenders. So still, this mortgage loan can default it. All in all, what I'm saying here is fire insurance does not fully protect mortgage lenders from bankrupt from this mortgage default because of the special nature of the fire risks.
Given the time, this will be our last question. So, I mean, we understand that there is a value in corporate culture, but political donations typically determined by the C-suite and mortgage decisions made by lower level employees. So how could the belief from the C-suite affect belief of the rank and file loan officers?
Sure, that's another great question. So one question when you think about it is, what I have in mind here is, if you think about loan application process, is mostly composed of two main players, right? Two main layers of information. First one is loan officer. You can think about loan officers as local consultants who help this mortgage applicant to gather all the information and prepare the packages, right? And then the final decisions are made by underwriters. You can think about the underwriters as a more, so what I have in mind here is underwriters probably mostly taking these instructions from at the firm level. So the C-suite, like the CEOs or chief risk managers, they will give these instructions to underwriters. This is not an irrational assumption, because if you see that there's a recent dispute about the Wells Fargo being discriminate against the Black applicants in general. So last year, there's a lot of refinance applications for mortgages, and Wells Fargo denies more than 50% of them, Black, while Bank of America and others accept 70%, 80%. So it seems to be that firm level, even underwriters have differences between firms. So I think this difference is most likely coming from the C-suite, right? And moreover, if you think about that, another channel, it could be that these banks, these employees have similar political views as the CEOs and other people, right? For example, another paper I have with Lana and Victor, which show that the CEO's political choice also affect the employees' political views, right? So it's more likely to have this underwriters being Republican-leaning attracted to Republican-leaning firms, but Democratic-leaning employees also attract Democratic-leaning firms in general. So these are two mechanisms I have in mind. Both of them can explain this result.
Thank you very much, Song. Great presentation and great Q&A. And I will hand it over to Henry now. Thank you.
Thank you.
Thank you, Uni, and good afternoon, everyone. I've been tasked with bringing this event to a close, and I want to do this first by thanking you for joining us this afternoon, and also for expressing FIASI's gratitude to everyone involved in today's presentations. And second, by asking for your feedback. Congratulations to all of our research competition winners. Thank you, Aymeric and Song, for your research and revealing presentations. And many thanks to the rest of the students who participated in the competition by submitting their research papers, including our runners-up. Picking up on Song's theme of a partisan divide when it comes to climate change, some or all of you are surely aware that sentiment around ESG has taken a negative turn. ESG is also becoming politicized, even before we have a universally accepted definition of ESG integration in investment decisions. At least that's my view. Here are just 3 developments on this point. First is the adoption of legislation by various states seeking to penalize managers or other financial institutions that either exclude investments in or discriminate against companies in the fossil fuels, in the firearms, and/or ammunition sectors. As many as 25 states have either banned or are considering a ban on practices involving the inclusion of ESG in investment decisions. Second, 16 governors recently sent a letter to President Biden requesting that he withdraw the US SEC's proposal that would mandate climate disclosures in financial reporting. And third, and I'll leave it with the third one, the state of Utah's very public objection to any ESG ratings, ESG credit indicators, or any other ESG scoring system that calls out ESG factors separate from, in addition to, or apart from traditional credit ratings. And this was in response to S&P Global's publishing of ESG credit indicators as part of its credit ratings for states and state subdivisions. One important way of responding to such developments is to enhance our collective knowledge and facilitate learning through publication of independent and objective research of the type that we've been exposed to through our annual ESG and fixed income research competitions. And in fact, this is another important motivator, in addition to the ones that Donna mentioned, for continuing this joint initiative between FIASI and the Fordham University Gabelli School of Business. Over the next couple of months, we at FIASI, together with Fordham, plan to sit down and to discuss the research competition and decide how best to proceed with this initiative. We would welcome your feedback, comments, and suggestions on how we might further develop the competition. Please feel free to forward your comments either directly to me at henry.schilling@fiasi.org or to Lauren Nauser at nauser@fiasi.org. Or if you prefer and you wish to have a conversation, please reach out to me and I'll gladly schedule a call with you. Thank you again for attending, and we look forward to seeing you at our next event, most likely in early September. For details, consult our website, and in the meantime, have a very good evening.